Well, I'll start since I've already been introduced earlier. I think this has been a very interesting day, focused from quite different perspectives, from policymakers, DoD, industry, commerce, and so forth. So we want to talk a little bit about investment, and we've touched on it a few times earlier throughout the day, and I want to look at it from the standpoint of the electronics industry, from my perspective, but hardware in general. And I would say the data would say that from 2007 forward, we've had a significant decline in investment in hardware, looking especially from a venture capital investment standpoint or a PE investment. So hardware has significantly declined, particularly in semiconductor technologies or electronics. Software and healthcare have exploded, and the hardware and device has gone virtually to zero. We did see a little bit of an uptick in 2017, mostly on cryptocurrency mining chips or AI chips. It's continuing. But overall, the issues are time to exit, so we don't have patient capital. The total amount of investment is significantly high. We hear, one entity in the government may have $13 million to spend, another may have $2.5 million or something like that. But it may take $100 million to bring a device to fruition, to market, and it may take 10 years, which is beyond the horizon of most VC funds. So those issues, plus a growing lack of expertise in the hardware space from an investor standpoint, are significant issues impending the investment in hardware. So I'm looking forward to the discussion from everyone here on how we improve that.
Thank you. Shirish Parikh, I'm with AMG Partners. It's a fund that I started to focus on advanced manufacturing growth. I've been in manufacturing my whole career for more than 25, 30 years now, primarily focused on heavy manufacturing, working with customers like Caterpillar, Bobcat, John Deere, and others. And for the last several years, I started to see this whole opportunity in advanced manufacturing. And during the time I served on President Obama's Manufacturing Council from 2012 to 2016, we got exposed to this whole new area of advanced manufacturing. We discussed the setup of national manufacturing innovation institutes. And one thing that became very clear to me is the funding challenge when it comes to advanced manufacturing. So I decided to focus in that space. So I'll try and lay out some challenges, and as the discussion continues, we will get into solving some of those. So the challenge I see from a private equity standpoint, if you think of how private equity started, they started during 80s, and it was all about spreadsheet engineering and financial engineering. The focus was on breaking and managing assets and capturing value. So it was a very different financial engineering focus. From that, private equity in 90s focused on a little bit of sort of operational improvements because they realized the financial gains were evaporating. And then the focus shifted to low-cost sourcing, which we call outsourcing, global sourcing, which we've seen the outcome of that. I personally participated in running more than probably a couple $1 billion of reverse auctions where the prices keep going down and our executives cheer as US suppliers lose and Chinese suppliers were winning. And I personally directed several of those auctions. From there now, private equity is focused on operational improvement a little bit, but what's needed going forward, I don't think private equity is currently tuned in, which is long-term focus, the topic that came out earlier, and also innovation and investment. If you think of PE, their focus is 5 years, how do I extract value? How do I pay down the debt quickly, as fast as possible? Investing long-term R&D transformation doesn't fit with that mindset so far. It has to change. So that's PE funding. Second is VC funding for startups. VCs like return on investment. They like scalable models. If I can invest $5 million in a company and with 60 employees create a WhatsApp and rule the world and have 99% gross margin, that's VC focus. It doesn't fit with advanced manufacturing where you will have material cost. You will have 30, 35, 40% cost of material. You will not be able to have infinite scalability because as the business grows, you will need to have warehouses. You will need to have plant and equipment. You will need to have supply chain. And then third area of investment in advanced manufacturing, which again, I'm focusing only on challenges, is businesses that are owned by families. Mid-sized, small SMEs, there was a discussion earlier how many SMEs are in the country. Sometimes they may not have the capability or long-term horizon to focus on investments that are needed. And if not addressed, they could face the same challenges as they faced during the outsourcing wave of late 90s and 2000s. Large companies did fine. They were able to deploy their armies of executives to overseas and set up plants and factories and suppliers. Mid-sized companies suffered, and I believe the same could happen here if we don't address these 2 or 3 challenges. But more to come on that. We'll talk about solutions and what can be done.
Thank you, Shirish. My name is Afshan Khan. I have a background in manufacturing for over 20 years, and upon exiting our manufacturing company, I was able to join one of the Ben Franklin technology partners in Pennsylvania, Southwest Pennsylvania, by the name of Innovation Works. For some of the points that were brought up by David and Shirish, we try to address some of these issues specifically. Innovation Works has the 4th founded hardware accelerator in the country about 6 years ago by the name of Alpha Lab Gear. It was initiated because of the democratization of some ability to do product iteration with respect to rapid product iteration and fail and find out what your customers are really looking for. We provide up to $50,000 for a small amount of equity, and it's an incubation program, but an acceleration program as well. We have a lot of program, and perhaps the only accelerator in the country that focuses specifically on building design for manufacturing capabilities here in the United States to manufacture here. And then our parent, Innovation Works, has up to $600,000 of funding, followed on by Riverfront Ventures, an early stage VC that can follow up with another $1.5 million. So it's a drop in the bucket from the standpoint of the monies that are needed, but it's an initial focus on how to support hardware startups, not just with the product and the technology, but the market validation and the business end of it. A lot of these folks come from academia. A lot of them are PhDs, and they have a very good knowledge of their product and their technology, but they need help on customer discovery, market validation, and the business ends. So I think there's a lot that can be done. We, as part of Innovation Works, do get quite a lot of support from different federal programs, as well as state and foundation support. From the DoD Office of Economic Adjustment, we have helped manufacturing initiatives that I'll speak about later, because in southwestern Pennsylvania, we still have a very strong, almost 4,000 strong small manufacturing base. But we'll talk about some of those programs and perhaps how some of those programs can be expanded to support greater connectivity between startups and manufacturers.
Hi, my name is David Adler. I work in the closed-end fund industry. I'll explain what that is in a minute. And I also write about productivity and premature deindustrialization for something called the CFA Institute Research Foundation and lots of different policy magazines, such as American Affairs. A closed-end fund is a 40-act structure equivalent to an open-ended mutual fund. They're really both the same. The difference is a closed-end fund is a permanent capital vehicle. It actually has a capability for patient capital. However, it is not used. This capability is not used for this purpose. Instead, the permanent capital is used to invest in traditional asset classes like muni bonds, which then leverage them. But I'm just saying it's out there as a solution that anyone could invest in. It just has not been used this way in this country. In England, there are permanent capital closed-end funds which have had a mixed investment track record. Above and beyond that, today we're basically here, as far as I can tell, to talk about the scale-up problem. There's this market failure that people come up with a startup in manufacturing and then have problems scaling due to financial constraints. So talking more about that, you know, the line that success has many fathers, in this case, failure has many fathers. Some of the fathers are in this room. I should change that and say some people who have identified the failure are in this room. They're not responsible for the failure. So that would include Sridhar, our organizer, and Bill Bonvillian and Hiram. And actually everyone on our panel seems well aware that there's this failure and the inability to scale up. But really, why is there this problem scaling up? I mean, I think what has not been discussed today at all is part of the problem relates to the collapse of another innovation system in the US, namely the corporate innovation system. So historically, places like DuPont, through experimental station, would invent something, and they had no problem scaling up because they could get the finance, they would just self-finance to do that. But since all the US corporate labs have pretty much been shuttered or broken apart, or actually a major turnaround investor called research a folly or frivolous or a hobby, that all those things have been shut down. So all we've got left is the academic system, which is really not perfectly suited to this. But nonetheless, new ideas do come out, and the question is, how do you scale them? And as we've been hearing again and again and again, venture capital is not interested in this. It has a poor risk-return trade-off. It takes forever to do. It's risky. It's capital intensive. So in short, there is a market failure. However, there are lots of solutions. Unfortunately, those are not being used in the US. They're being used throughout the world, from China to Israel to United Arab Emirates to Norway. Everyone has a solution, just the US does not. So in terms of what is the solution, I think the real solution is regulatory. So some of the speakers throughout the day, such as Senator Rubio or other ideas we've heard, I think those are the main solution. As a secondary solution, I think tax incentives could be helpful to channel investment in this direction, to channel investment into the real economy away from the financial economy, where it just seems to fund itself into pointless investments to try and increase returns. And we can talk more about that, and perhaps qualified opportunity zones as an intriguing model for investment. I'm not talking about it as a policy model, I'm talking about as a model of how you can channel investment in a certain direction and be successful at channeling investment. So next.
Yeah, I think, David, has some really good points, and I think the other elephant in the room that we talked about earlier is China, and you just touched on that and their investment policy. You know, I talked about the lack of hardware investment in the U.S. That curve is just the opposite in China. There's been a tremendous growth of investment in hardware, in startups, and in scaling in China. But it's not the first time we've seen it. You know, we point to China today as this panda with cards up its sleeve, but in the 80s we saw Japan do it, very focused industrial policy for investment. In the 90s we saw Korea do it. In the early 2000s, Taiwan, and now China. So each one has had incentives for investment. They've had property set aside with no taxes. They've had industrial parks. They've had research parks. So they've all had a common investment strategy for the country to grow strategic industries. We've seen a lot of the DoD budget and other elements across DOE, commerce, where there are pockets of investment available. If you pulled all those together, it could be a pretty significant amount, even what's currently funded today. But we've never looked at it as a portfolio of investments and steered it towards strategic investments as a quote-unquote industrial policy that enables us to make those investments that pay off over the long run.
If I can pile on the China comment, their industrial and investment policy is not just confined to their own country. They have a significant investment focus within US, both on the venture side. So there are lots of venture startups that we come across where they go around, spend money and spend time and effort in Silicon Valley, end up with no funding, and next you know they are being funded by China with three promises: capital, access to China market for their product, and then access to the industrial, as Sridhar you call it, the industrial opens, industrial commons. So if I am a founder of a company and if I have a device for whatever, it's a vibrational analysis device or let's call it augmented reality device, I get $10 million from China. They promise me to open up their whole country market for my product, and suddenly my product is up and ready in 3 months. it looks very attractive to me as a CEO. So that's another thing. So that's one area that their policy extends beyond their borders to US. And the other thing that we have started to see recently is buying existing old companies in US, even if they're small companies. We all know the big bets that China makes and buying bigger companies. Like they bought Keystone Safety Systems, which is the largest sort of $5-10 billion company for all kind of safety related products that go into automotive industry, from airbags to seat belt to bunch of safety products. That's owned by a China player now. But even smaller, $20 million companies that the Chinese buyers are here bidding with us, with private equity, trying to acquire those assets. And it's the same message to the owners that, look, you are 20 million here. If you sell your company to me or if you become my partner, you would be 200 million in China. So that's just something to be aware of. I think, again, we're talking about the discontinuity and then also sort of going to the discussion earlier from sort of Chinese threat. But I see clearly ways in which this could be changed. We had discussions a month ago with Senator Rubio's office as he was working on the reauthorization of SBIR bill, where providing the necessary incentives to financing firms where as they invest in more advanced manufacturing technology companies, there are certain incentives. So instead of their fund getting 150 million when they raise 75 million from private markets, maybe the fund is up to 500 million because they are earmarking capital investments in advanced manufacturing. Or similar sort of incentives for venture capitalists where there are tax benefits to them as they, or to the LPs, if the investments are directed or geared towards some of the advanced manufacturing technologies.
And if I may build on that, I agree with everything that Shirish and David have talked about. I think there is still an opportunity, though, with regard to new research, new product and technology, especially coming out of our universities, that their lack of knowledge and understanding how to scale their product is best served locally. And so we at InnovationWorks have a lot of manufacturing initiatives that really focus on trying to make those connections. We started that about 2+ years ago. It's in its beginning stages, and what we find with small and medium manufacturers in particular is they have knowledge that's not necessarily easily transferable, but that can be connected with the startups to help them, at least in those initial product iteration stages, and on the road to scaling. And from that perspective, if our manufacturing policy, as the Honorable Mr. Peters had spoken about, would support some unity in terms of overall comprehension of the different programs out there, there's a lot of opportunity for manufacturers to not only engage with startups, but also to adopt greater rapid innovation within their own manufacturing systems and make them smart manufacturing. And I'm going to, am I speaking okay?
No, I was just looking at your first name. Nothing.
Okay.
You're doing fine. There's no fly flying around. It wasn't like a fascinating tag.
But I'm going to jump on the bandwagon for something David had said earlier, and perhaps this is a segue for you. We have these manufacturing centers within the close proximity of Pittsburgh. We have the latest advanced manufacturing center being the Advanced Robotics Manufacturing Center that started in January 2017, and about, I want to say 2012, was the NAMI, National Institute of Manufacturing for Additive Manufacturing in neighboring Youngstown. Those are some great institutions, and I think I'll give the floor to David because he had some great ideas that aren't necessarily in
I was actually looking around to get your first name, Ashan. If I can call you that. It was just to say, as Ashan just said, though, our whole panel here is really about the finance side. In fact, there's actually an institutional side problem as well, namely that the U.S. lacks translational institutions that take theoretical academic research and apply it, such as the Fraunhofers in Germany or science parks in Taiwan. So what's intriguing is that there are solutions that somehow manage to get through the system out there, namely the manufacturing institutes. But we had a conversation offline that even though the institutes in Pittsburgh close to her actually have a robotics focus, it doesn't mean they're integrated with what you're doing. So it's an example yet again where things haven't fully been pulled together or integrated. So there have been exciting elements of progress in the US, but somehow the whole system is not gelled in a way that it's efficiently moving together, and there might be another type of failure there.
David, if I can pick on your comment, we discussed this issue of innovation in universities and labs, and then lack of manufacturing ecosystem probably 6, 7, 8 years ago at Manufacturing Council. This was a big topic. This is what led to the setup of Manufacturing USA, the institutes, 13 or probably 14 now. And I know Jim Davis is there, there might be a few more executive directors, but I think those institutes can be really repurposed and purposed for what we are discussing now, to the idea that Secretary Al had about trusted network. Those institutes can become a trusted networks where the VCs can coalesce around and saying, in many cases, and I visited several of them over the last few years, some of them have become trade shows. They've become places where you go and look at different technologies and you get a tour. They were never supposed to be a places for tour. Hey, look at all these 10 technologies, get a nice tour of the facility. They were supposed to be places where innovation happens. People gather to solve the big problems, make machinery for producing what is being discussed. So I think there is an opportunity to rethink and take those to now that they are set up, to take them to the next level, including startups and training around those institutes.
And if I could build on that for just a moment, and you folks are expert in terms of what these manufacturing centers were intended, but I think the membership model in these manufacturing centers doesn't work to the ends that they need them to work. It needs to be a different model.
That's a fair point. And as we talked, the valley of death is real. Getting technologies out of the research and into a scalable manufacturing base is what the intention of the manufacturing institutes were. But the question is you know, the $12 million a year for 5 years enough to actually do something like that?
I'm going to throw you guys a curveball.
All right.
So Ken had appointed David in charge of all hacking from now on. We're now in charge of you guys, the voice of all investors for the whole world. What questions and frustrations do investors have with the rest of us? We don't understand why you guys do it this way. We don't understand why you don't do this. If you were to think of all the investors out there, their frustrations, their valid points of, if you guys just did a little bit differently, it would work better. What questions do you think investors have for the other sectors? What comes to your mind, Dave?
Well, you know, frankly, over the last year or so, I've been evangelizing with a lot of the VCs around Silicon Valley and frankly around the world, and trying to bring them together to discuss the issues of why they're not making those investments. And as I opened with, you know, it's the time to exit is critical. They want that rate of return. But more importantly, the time horizon of their funds is usually 5 years and not 10 that it might take for hardware to come to fruition. And you know, they can invest in software and they can do multiple companies where, you know, they might have a singular investment from a fund. So they're actually looking together to form a fund of funds of sorts. And actually there's one group of them that in Europe that are going to the EU to match funds for that fund of fund to get maybe $100 or $200 billion fund that can be used to invest in hardware that has a time horizon.
We're hearing the same critique. Companies were not thinking past the quarter. Elections were not thinking past the cycle, past the fund. Why? My new company just opened their second office in China, and one of the Chinese companies, not even one of the big ones, Power China, has 200,000 employees, and they're hiring us to train their people to present better in Africa and LATAM as they're pitching projects. Why are we not able to think more long term? What is it that's blocking us?
Well, here we're saying there's a low. Go ahead.
The other thought. Are we too selfish, not selfish enough? What's the problem?
Well, I think, you know, we're very individualistic as a nation. I mean, we make our money and make successes, individuals, as companies, not as a collective environment. So, you know, I think China in
that's
particular.
kind of what Sridhar we're talking about. We're getting ours,
Right.
but we're not thinking bigger. David?
Yeah.
Oh, I was just going to say, it's, you know, just from a risk-return perspective, that the return, it's just a lower expected return investment. So it's not the highest return, so you need to change the equation slightly, possibly, well, primarily through regulatory reform, so there's some sort of guarantee, but secondarily, perhaps through tax. So just to get qualified opportunity zones off my chest. I'm not endorsing them in any way. And I don't even know if they're a successful investment, but they've been successful at raising capital. What they are is they're tax deferred or favored investment in communities deemed underprivileged. So anyone is starting a QOZ fund, like Chris Christie's wife is starting one, or the Mooch is starting $1 billion one. There's an entire industry in Washington now. There's a trade group called the Institute for Portfolio Alternatives, formerly the Non-Traded REIT Association, which is completely committed to this investment. So there are millions of financial advisors doing it. There's a whole ecosystem around one investment. What I'm saying is that could be an intriguing model for what I think is a more socially productive investment, or as socially productive an investment in hardware. But it required tax tweak.
Afshan and Shirish, same question. What's the investment community's frustration with the rest of us, and then open it up for anything anybody else wants to ask or say.
I don't think the frustration is with the companies or startups. I think the agency problem exists with, or the incentive problem exists with the financing community, and including the public companies, where the focus is short term. So that's why a lot of R&D department, to David's point earlier, have been decimated, because the focus is short term. And there is this major transformation coming, but it'll require investment. This whole transformation, I recently invested in an automation business, and FANUC, which is a Japanese, the largest robotics manufacturer in the world, they are setting up another facility in their headquarters, 2 million square foot facility. They've seen the demand signal of what's coming. They know more and more companies will be buying robots and setting up. I think the issue is more on the investment side, becoming more long-term focus, as well as understanding that there are different returns for these kind of businesses. And then I think, to your comment, it's the individualistic or agency problem.
But is that an American issue? And then we'll get Afshan's thought here. Some of my European investor friends say, I've been watching them. Hey, we're switching from Eastern Europe. We watched the cranes move from Dubai to Abu Dhabi. We're now, money's moving towards Africa. Nobody was investing before. Now they're investing because it may not be 50-year horizons anymore. It could be 10, 8-year horizons. Afshan, your thoughts?
To build on what David and Shirish have said, I think it is a problem with the investment community. And to give you an example, we've had several prominent startups, robotics focused, in the Pittsburgh area recently get some decent funding, just decent, not great. And part of the reason was they had to actually essentially hide the idea of their robot as part of their pitch to investors. Because people don't want to invest in that long-term, as Shirish had talked, a long-term horizon of robotics. And so they had to go forward with data, forward with software, machine learning, AI. We have to recognize that the transformation is going to take time. And from that perspective, if government, along with corporate and foundation partnerships, can expand opportunities, let's say, for additional SBIR and STTR opportunities in terms of long-term manufacturing changes, hardware changes. I know that in our relatively new program of manufacturing initiatives to help connections between manufacturers and startups, we've gotten some decent federal funding. It would help to do more. We feel that there's a lot more opportunity. If we create more revenue streams for our small and medium-sized manufacturers within these new technologies, they themselves can transform, and that knowledge and manufacturing base can be revitalized.
So I'm hearing a couple of things, and raise your hand if you have a question. Josh will bring you the mic. But I'm hearing the institutional challenges, and I'm also hearing the individual ones. Some of you would remember a reference of Pogo, this very old comic strip in the newspaper, but their famous quote was, "We found the enemy, and it is us." That it isn't just everybody else who isn't thinking long-term, it's us. A friend of mine changed my thinking on this last month. He was a co-founder of the internet company that I had started, and really the reason it was successful. He was the top chess-playing kid in the world at age 5. And he's Mr. Fact, no exaggeration, he's just brilliant. And he said, he said, they're this close to us living to 100, 110. It's like, come on, really think so? Like, never exaggerate, so that really got my attention. He said, yeah. I said, are we going to be in decent health the last couple decades, or not very good health? He said, we could be in decent health in our 80s. So what's the rush? Like, why are we killing ourselves, not taking care of ourselves, not getting enough sleep, not doing this stuff and doing all this short-term thinking when we may have time to plan and prepare? So that really made me shift a little bit in how I was doing things.
Well, I have a question about the Manufacturing Innovation Institute. Somebody, actually, I think it was Sean Khan, she said the membership model is not working. And I would like to know if there are any suggestions for that, because as far as I know, most of the successful institutes around the world have a membership model, including Fraunhofer, the IMAC, Catapult. So I would like to know if there is any alternative suggestion there.
Afshan's thoughts first. It's like the old Amex commercial membership has its privileges, not anymore.
So I have to ask the question, who's here representing those manufacturing centers? Are you part of those manufacturing centers?
Yes,
Got a few.
Okay.
So they can chime in, you guys can chime in as well.
So in terms of technology awareness, getting the word out there about additive and advanced manufacturing, about increasing understanding of robotics and different opportunities for changing manufacturing processes using robotics, those things are great. Workforce development has also been a very strong growth opportunity for these manufacturing centers. But part of the challenge is that when you have this membership model, and this is, forgive me for my relatively small knowledge about this, but those membership models are there because they've gotten some finite funding for a period of 5 years, and within that time frame, they have to figure out how to sustain themselves. And that's where the challenge comes in. Do they provide enough value? Is it a long enough time horizon for them to be able to establish enough corporate relationships, enough value and connections to the startups who can't afford very much in a membership model in terms of joining? Can they stand up in that 5 years' time? And, you know, I think.
Is your feeling 5 years is not enough runway?
Not enough runway.
And not enough funding. I think if you look at the success of IMAC, Fraunhofer, you know, you have to go back in time and see that, you know, the vast majority of their funding came from government funding. In IMAC's case, the Flemish government funded some 80% of their activities in the first few years, and Philips funded the other 20%. So, you know, the membership over time then became membership in specific areas of interest, not in the total pie. And so they're very successful because they've gone down the path of very interesting technologies and have multiple entities members of that particular development activity, but not of the entire entity itself.
And sorry, just to build on, I agree with what Sharice said. It's become a trade show showcase versus the deep engagement.
Other questions, raise your hand. Jim, over there, and then Scott, and then Leo.
If I may, this is a comment and a question. On the membership model, so I'm representing the DOE Smart Manufacturing Innovation Institute. What we're seeing is that each institute has its own kind of agenda and the way it's taken it forward. And so the membership models have been directed at those particular agendas. And so we find it actually, there's a lot of desire to work with other institutes, but the membership models don't align. It becomes very difficult to do projects in some kind of cross-institute way. The other thing that's also a very big issue is the national labs. The whole setup of the institutes make it very, very difficult to work with the national labs, even though there's a huge amount of capability, as was talked about earlier this morning. If I may, can I switch gears? This is a question to an investment group. From much of the discussion today, there have been these sort of snippets of the importance of data, the importance of cybersecurity, and so forth. But when we get back into the innovation kind of discussion and the investment side of kind of discussion, we kind of flip back to things, you know, physical technologies, artifacts, and we move out of the cyber side of things. So I'd like to kind of call that out explicitly, and my question is about investment in the cyber side. So generally speaking, in the smart manufacturing side of things, it's all about the data, how to draw on the data and use things, and it's all about how do you actually build capability. So we talk about it already. You know, capability would be productivity. Capability would be managing cybersecurity, or even turning cybersecurity into an economic advantage. It would be precision. You know, all these sorts of things that are necessary for manufacturing to go forth. But when I listen to an investment panel, this is, and I'm talking about years of discussions, not just this one. It flips back to individual company investment. And so there's this really huge question on the cyber side about individual company investment, and then what does it do to providing this kind of capability, which we all talk about needs to be extended kind of across the ecosystem. A really good example is in play right now, and it is cloud. And there is so much investment in individual cloud products that from our perspective, cloud is actually causing the problem of using data in an industrial fashion. It's making it worse and worse and worse. It actually harkens back to about 25 years ago in terms of how hard it is to get data. And so you run into this incredible complexity with interconnected cloud systems. How do you deal with this? So what I'm really kind of saying, the investment is kind of taking us down this path of making the problem worse on the cyber side, and how can we invest differently to kind of get out of that sort of mode here?
Just to say that, in fact, Germany, through Industry 4.0, is highly focused on investing, you might say, in the cloud through the Internet of Things, IoT. Maybe that's not what you mean.
Yeah, please distinguish state investment versus market investment.
Well, it's a nationwide effort because what they perceive as a market failure, that they believe their industry is falling behind because they actually turn to America as a model in some ways because America has a high-tech industry and they're not as advanced. But specifically about the cloud, what's interesting is Siemens has a cloud, as does Microsoft, but the Germans won't use Siemens because they're afraid of sharing trade secrets, where they figure Microsoft will never manufacture. So they'll turn to an American cloud, pointing again to inadequacies in the American system.
So our focus of discussion, as you observed, is more around product and technologies related to advanced manufacturing. I would say that there is enough investment going on the software side. And again, depends on which numbers you look at, but 95% of investment goes into healthcare, software, hardware related to software technology, and very less than 10% goes into manufacturing related products. So my exposure to cybersecurity is limited, so I'm not sure if that's investing or funding of those kind of companies is a challenge.
Okay, first I'll talk a little bit about the membership models, because being a DMDI, I think we probably had one of the best of them, because it was, I think it was only $500 for a small to medium-sized business to join. And we had so that in that case we had like probably 300 sign up, but where was the value? It's like they're signing up, and I represented them on the executive committee, and they're like, well, I'm paying $500, but I'm getting no value out of this. Because to really navigate the whole working with the universities and writing proposals, they don't have time to do any of that. And so it's just like, to really get the value, you have to put the time into it, and they simply don't have the time to put into it. And so they can't dedicate those resources, where the big companies, of course, can. And so then the model sort of shifts to how do we cater to the large companies and become sort of a trade show. And that's just what happens. And it's just a market. And the same thing goes with the capital. I don't know how you would solve that one, because the bottom line, people are just going to be opportunistic. They're going to be like, we're going to put my money in to get the highest return on investment. I think the only patient capital is maybe the government. And I find it interesting, even the Commerce Department, when you look at the SBA administration, they're giving out loans. Why wouldn't they have a preference towards manufacturing, towards certain NAICS to invest in manufacturing? They're not doing that themselves. So I think they could start at the SBA and say, hey, let's invest in manufacturing and lead by example.
I will follow along the same line of thinking these participation models. There is a tremendous transactional cost in participating in the institutes. Don't underestimate what it takes, whether it's $500 or $500,000. There's a huge transactional cost on our side to interact and to derive value. And the resources are limited not only in terms of money, of course, but in people primarily. If I have a researcher who, for the sake of argument, is working on additive manufacturing, rather than sitting in a committee in Pittsburgh or Johnstown or wherever it might be, I'd rather have him or her be in Seattle or in St. Louis actually building parts. So there is that issue to it. So I think the models, and I was part of the original Manufacturing Institute's idea, so of course we worked together on that. I think what we need to understand is that the government role, us, the government is us, right? We're paying dollars, this is us. Every April the 15th, it's our dollars at work. How do we want to expend those dollars? So let me give you an example where we, the taxpayer, I wasn't paying tax then, that we made those long-term investments. It's called the freeways. Freeways. They're called freeways, right? Because they're free. Well, for the most part, other than the Pennsylvania Turnpike. But the bottom line here is that they're in the freeway system, Eisenhower built for the defense. Remember, that was original, so you could move tanks around the country if you had to. If you don't know that, that's why they were justified initially. If that is the case, then as a result of the freeway, a lot of venture capitalists put a lot of money in distribution, in FedEx, in UPS, whatever, in the automotive industry that moved things back and forth. So I think we as a nation have to decide that for these core things, we've got to build these freeways. And the freeways from advanced manufacturing are things like the institutes, the manufacturing demonstration facility, I think that I'm very proud of at Oak Ridge National Labs. If you haven't been down there, you should. It's really quite impressive what they've done. And it doesn't only happen in the US, it happens elsewhere too. I'll give you one more example, if you will indulge me. 15 years ago, the Boeing company, as a part of an offset, there's a gentleman right there who raise your hand, who was instrumental in doing this, had an offset requirement in the UK. They decided they would put a little bit of money in a coal mining industry. It was, I have the pictures. It was a pit, a coal mining pit. It was a disaster, environmental zone that was disastrous. 15 years later, today, we've just built a $100 million factory, state-of-the-art, based on the technology that was developed at the AMRC Advanced Manufacturing Research Center in Sheffield, where they focused on machining technologies. We have built now a $100 million factory, employing local people in Sheffield, interns, actually tradespeople, because they came out of trade schools because they're machinists. And that factory is building parts for our aeroplanes. It took 15 years, though.
That's a great example, and he's referencing Scott, of course. Tom, did you have something? Tom, take the mic back here. What I like about Leo's thought of the freeways is you win 3-4 times on the float, because you not everybody benefits from the freeways, but we benefit from even building the freeways. And when you come together to build the freeway, you create these new systems where we can now come together to build other things quicker, faster, cheaper. Tom.
Yep.
Okay, I'm Tom Mahoney with MForesight. I want to turn the conversation a little bit back to investment, actually. You guys are probably familiar with what's typically called state venture funds, of which there have been a few in various kinds of states. And there have also been examples in other countries that David, I think you've written about a little bit. One that we heard about at our summit last year is in South Carolina. Their model, if I recall correctly, is that they sell state tax credits to fund the venture fund. And last year, the legislature raised the limit on the tax credits that they would sell because they're always oversubscribed. And then they use that to invest in startups and scale-ups in South Carolina. And I wondered what your opinion was of those, if that's the kind of model that could possibly be scaled up on a national level. The downside of these things, as I think Texas is an illustration, is that sometimes they get captured by the good old boys and corrupted, and in Texas they shut them down. So, but at any rate, it is an alternative. If the private sector, the private VC community, in and of itself won't invest in manufacturing, this is another potentially scalable model, and I wondered what your opinion was of that.
Who wants to go first? David.
No, it's a great model. It's just a tiny model. They're minuscule when you compare the size of them, say, to Belt and Road in China, a trillion or multi-trillion-dollar initiative. We're talking, this minuscule effort in South Carolina, which is good. It's just too small. But it does point to the fact that ideologically, states don't have the same resistance to industrial policy that you might encounter at the federal level. So there might be more action at the states, even if smaller. So there might be more room or opportunities to pursue some of the ideas mentioned in this room at the state level.
Let me do an audible on Tom's question, David's answer. Everybody in the room, see if you can think of a state that you think is really getting it right. Take all the stuff we're talking about, everything we've been talking about all day. Say, you know what state's getting it more right than everybody else? What's the first states that come to your mind? Don't overthink it. New York, Mass, Indiana, Massachusetts, Pennsylvania. Well, come on, West Coast. Come on, Southwest.
South Carolina.
And one of the things, it's the fusion-fission argument. If somebody does it and it's working, people follow. So we want to make sure we're giving some love to the state leaders who are, and even municipal leaders that are really metro areas to do it. Great. Other thoughts to
So
Tom's
while
question?
the states may be doing right, which several are, in creating their industrial ecosystem, I do have a concern with this idea of states getting into investment. I don't know how successful they are, the example you were giving, or even the country getting into, it can't be direct investment. The aim should be to create the right incentives and opportunities where professionals can invest with.
Is it impossible to do both? It'd be
I
hard.
understand the China One Belt example, but that's a different culture. In US, I don't know if there was a $1 trillion fund sitting in Washington, D.C., and they were deciding which company to invest in. I think there would be new problems that we are not aware of today that we would be discussing.
Fair point. Dave?
But I also think it points to incentive-based investment, whether it's tax incentive or otherwise. I mean, something like you mentioned Texas. Well, there's a depletion credit for investment in natural resources, and that allows investors to basically take a tax credit over time on an annual basis to recoup their investment in searching for natural resources. Why couldn't we do that with technology investment? Something like that. So incentives are there and they work.
Got time for another question or two, then we're going to take a nice break. And then the money folks have said, as a parting gift, they brought wheelbarrows full of money for everybody that they're going to hand out at the break. And then the legislators, John, Tanya, Casey, Caleb, and Mark, are going to come up, and they're going to be responsible for legislative solutions after the break. The last question or two?
So I wanted to, this is probably more relevant to semiconductors right now, but I was talking to Keenan here. I can remember
Hiram,
the
can you
old,
hold the mic a little closer?
I can remember the old Semitech days where the coordinating, what was interesting I found about the semiconductor industry, the machinery industry in the United States is that they basically all got together, a highly volatile industry at the time, and basically said we can't all survive in all these different sectors of it. So they basically divvied it up, so they basically had almost a monopoly in a very small, thin piece of it. And they all succeeded, and they all basically stayed in the United States to the best of my knowledge. Is that something that could take place today? I mean, I know they had to get antitrust exemption. What were you saying? They had to get FATCA? They had to get FATCA exemption. Is that something that we could do in renewable energy? Is that something that we could be doing in battery storage? Is there something along these kind of coordinated mechanisms that we're missing the boat on?
And I like about that, what I like about that question, give you an extra couple seconds to think, is Senator Peters, if NIM comes to pass, it's not going to be the panacea. They're still going to have to make tough decisions on where they put bets, right? 53 possible strategies, we're going to bet on 6. They're going to make those tough choices because we can't spread it all out too thin. Your thoughts?
Well, I can speak to that. I was on the startup team of Semitech and spent quite a bit of time there. It came from both directions, from a national defense, from Department of Defense, as well as Department of Commerce from an foreign investment standpoint. The focus was creating a domestic infrastructure, and the money was real. It was $100 million a year, arguably $90 to $100 million from industry, matched by $90 to $100 million from government. In 1988 dollars, $200 million a year was a significant investment. That done over time, so I think the federal investment lasted for 7 years, and it made a significant impact in developing the infrastructure. And as you mentioned, and I said earlier, those companies are still here today. It did require antitrust agreements, but falling within that, it was based on pre-competitive technologies. So it was developing technologies that all the companies would have to individually develop themselves. So develop it once rather than 14 times. And that was a success. And I would argue that the manufacturing institutes are modeled around that model, but on a much smaller scale. $12 million a year versus $200 million a year. I mean, with the match funding, higher than that, admittedly. But in 1988, dollars is pretty significant.
Anybody else?
Just one quick point. It's like, what could motivate people today to do that? I actually had a conversation with Rob Atkinson yesterday at ITIF about it. So one motivation could be somewhat analogous to ESG. And not just climate change, but you could say the opioid epidemic, mortality problems in the US, all could be solved through reindustrialization. So New York State, which is now devoting $20 billion to climate change, maybe they should make an ESG analogous argument and say, well, maybe we should put some of that to reindustrializing. But Rob Atkinson felt that was actually an inadequate and insufficient argument right now in Washington, and he felt a better argument was competition with China. That mentioning China, just dropping the name China, is actually the lever to get people to do something and out of sort of our general stupor.
Yeah, we talked earlier about democracy being the most powerful country, being very important, and democracy is built on the middle class, and there's a growing divide between classes, and the middle class is shrinking. Reindustrialization of the middle class and retraining those workers, putting them to work, solves many social problems, including the opioid issue and that sort of thing. So I think focusing on manufacturing in those areas is extremely important for
And we haven't talked as much about the Middle East. A guy I know, Rick Little, got a $100 million grant from Qatar to create youth employment programs throughout the Middle East with the following theory. In Iran, Iraq, all the countries, tens of millions of young people are going to join the workforce in the next few years. If they get gainful employment, good things are going to happen.
Yep.
If they can't get gainful employment, bad things are going to happen.
Yep.
So that middle class is fundamental for stabilizing regions democratically, politically, economically. So that's a way to think about how our investment, it's not just about, can I make a few more bucks this year or next year, but can we leave a legacy for our kids, grandkids, and beyond that's stable, that's flourishing, that lets everybody else reach their potential as well. Speaking of reaching, if no last